Hey guys, what's up? You surprised to see me back with a video within 2 weeks of the last one? Truth be told, I'm probably the most surprised out of all of us. Anyways, I digress. This is part 8 in our Learn About Investing series, and today we're going to take a bit of a closer look at the relationship between asset allocation and risk and return. So from part 7, we now have a working understanding of asset allocation, which is the ratio of asset classes in our portfolio. And just as an aside, this is also sometimes referred to as your asset mix. So when people say either asset allocation or asset mix, same thing. Now, we briefly discussed how a 100% fixed income portfolio would be lower on the risk and return spectrum, and a 100% equity portfolio would be higher on the risk and return spectrum. But let's put these into chart form to show what this looks like graphically. On this chart, we have the value of a lump sum invested into a portfolio over time. So at this point, we are not adding any more money after this initial contribution. Later in the series, we'll take a look at the impact and effects of constantly adding money, but for now, just a lump sum. We'll start by plotting a 100% fixed income portfolio. And again, since this is on the lower end of the risk and return spectrum, we don't expect to see many years of losses, nor are those losses typically going to be big when they do occur. The trade-off, not a lot of potential for return. Now, after 10 years, our money hasn't really grown spectacularly, but it was a smooth ride along the way. Now, let's add in a 100% equity portfolio. We know that this portfolio is higher on the risk and return spectrum, so we expect to see more years where there are losses, and the sizes of those losses can be small or big. With this extra volatility, we hope the trade-off is a higher overall rate of return. And in this case, our money has indeed ended up being worth more than the 100% fixed income portfolio. Now, some people might be thinking that the higher risk portfolio, the 100% equity portfolio, really looked like quite the roller coaster, given that it was temporarily losing to the low risk portfolio, and it wasn't until right at the end that it started to pull away. Well, in the world of long-term investing, 10 years is not really that long. In fact, there have been 10-year periods where stocks have underperformed bonds. These are sometimes referred to in the media as the lost decade for stocks when that happens. Now, it's relatively rare, but it does happen. True long-term investing is significantly longer than 10 years. So let's look at a 30-year chart. And I realize there are some people who are probably not even close to 30 years old watching this video. Lucky you. Anyways, in this case, the first 10 years are exactly the same as what we saw on the 10-year charts that we've already seen. But now we're just adding in 20 more years of data for each of these portfolios. And remember, our low risk, low return portfolio has an asset allocation of 100% fixed income, and our high risk, high potential return portfolio has an asset allocation of 100% stocks or equity. Now what we'll see is a clearer demonstration of the trade-off between volatility and potential return. Yes, the roller coaster ride of stocks was all over the place in the short term, but historically, over long periods of time, we can have more confidence that we get compensated for taking on more risk with higher returns. Now, if we plot a dashed line on our low risk portfolio, we see that we start at a value of 10 and end up at a value of 20. So in this case, we doubled our money, but it took 30 years of this slow and steady trajectory. But let's plot a line on our risky portfolio. Again, we start with a value of 10, but this time we end up with a value of 50. So we've quintupled our money over 30 years. However, what if we go back just 1 year? After 29 years, we ended up with a value of 35. That's quite a bit lower than 50, but still quite a bit higher than our low risk portfolio. And the reason I'm drawing this to your attention is so that you understand that the range of possible outcomes is larger for riskier portfolios than for lower risk portfolios. And we'll talk more about that in future videos, but I did want to plant that seed now for you to think about. But really, the point of this video is to show how asset allocation allows us to play in between these two extremes. So generally speaking, a 100% fixed income portfolio is pretty rare for long-term investors. The potential return is just too low. And likewise, not many people go 100% equity either. The volatility is not easy to sleep with at night for most people. A middle-of-the-road option would be to hold a portfolio with an asset allocation of 50% equity and 50% fixed income. And it would be expected to behave something like this. Again, this might still be too aggressive for some people. And in that case, a 25-75 portfolio, and remember our lingo, when we just cite two numbers, the first one is usually referring to the equity percentage, and the second one is usually referring to the fixed income percentage. So this 25-75 portfolio would look something like this, and just to round it out, a 75-25 portfolio would look something like this. So, as you can see, you can adjust what kind of roller coaster your portfolio will look like. And with more risk, it is important to keep in mind that the range of outcomes is wider than safer portfolios, both during the short term, but also over the long term. Okay, the next thing we're going to cover is a brief overview of the different investment products that would fit into either of these top-level asset classes, equities and fixed income. That will help steer us into understanding how we would set up a portfolio in the first place, which I know many of you are dying to learn about. Right now, don't forget to hit the like button if you like this video, and let's be serious, to give me the dopamine hit required to reinforce the regular publishing of videos. I mean, we're all animals at heart. Everyone has their cheese that motivates them through their various mazes. And for YouTubers, it's the like button. So there you go. Also, this is part 8 in this series. If you haven't subscribed yet, that's just kind of weird at this point, so you should really get on that. All right. Thanks for watching this video. I will see you in the next video, which will be up in, let's say, within 21 days. I'm going to endeavor for 7, but that's probably not going to happen. Anyways, see you in the next video.